Top Block Mortgage Loan Committee. This is a financial analysis of a home loan request submitted by John and Martha Test, presented by Richard Kim, loan officer at Top Block Mortgage. Overview. John and Martha Test are first-time homebuyers with stable jobs and good credit looking to purchase a house in excellent condition in a good neighborhood in San Diego. Today, we are reviewing their loan request. As always, we look to originate quality loans using our standard framework with three key components: collateral, capacity, and credit. Collateral refers to the subject property which serves as security for the home loan. Capacity refers to John and Martha's income and assets, and credit refers to the FICO score and debt of John and Martha, which indicates their credit worthiness. First, let's look at the subject property, collateral. The house is located at 88 Ocean Avenue, San Diego, California, 92111. The price is $500,000. It was built in 2016, 5 years ago. The house is in excellent condition. It has 3 bedrooms, 2 baths. It's a single-family home in a good neighborhood in San Diego. Looking at the comparative market analysis, CMA, there are 2 comparable properties, A and B, in close proximity to John and Martha's dream home. Now, John and Martha's house is priced at $500,000. With adjustments, both A and B adjust to $500,000. So A and B's adjusted price is identical to the price of John and Martha's future home, $500,000. So looking at this table, just to explain the comps, the adjustments, looking at A, which is the middle column, I adjusted for the bedrooms and the baths. So the adjustments from our appraisers is $5,000 per bedroom and $5,000 per bath. The original sales price at the bottom is $409,000. With the adjustments, the comparable price is $500,000. B similarly was adjusted. Here with B, the main adjustment was to the bedroom. B has the same number of baths. So all 3 homes have the same price after adjustment. This indicates that $500,000 is a fair market price for the house that John and Martha are interested in, and this is a good number for us to use going forward. Now let's look at the financials of John and Martha to get a sense of their capacity as well as their credit worthiness. So in this table here, I'm looking at John and Martha's income as well as their savings. So John and Martha both work. They both have stable jobs. John has had his job for 4 years. Martha has had her job for 10 years. So stable jobs, over 2 years, income's been verified. So John makes $69,000 a year, Martha makes $52,000 a year. Combined, John and Martha make $121,000 a year. Their gross monthly income combined is $10,000 per month. John and Martha have excellent FICO scores. John has a FICO score of 720 and Martha has a FICO score of 780. As you know, a FICO score of 720 or higher is considered to be prime, good, excellent. And 780, which Martha has, is elite. Now in terms of savings, we verified that John and Martha have $110,000 in cash savings, which they are willing to use to buy their first home, this home that we're reviewing right now. Now keep in mind that this is a good amount of savings and it shows their ability to save. They're responsible adults here. Moving on, let's look at PITI, principal, interest, taxes, and insurance. The pity for John and Martha is $2,484, $24.84. Principal and interest is $1,968, and this is based on the following information. Home price is $500,000. They're putting 20% down. That's $100,000, which leaves a loan amount of $400,000. It will be a conventional loan of $400,000, 30-year fixed at 4.25%. Their PMI is 0. There is no HOA. Property tax is 1% annually. Hazard insurance is $1,200 annually. So we get taxes of $417 per month, and insurance is $100 per month. The total of these three numbers is $24.84. That's the pity. Now, using the pity to do further analysis, we're going to look at their debt as well as the ratios, both the front-end ratio, which has a criteria of 28%, and a back-end ratio, which has a criteria of 36%. So the top row has the pity number from the previous slide, 2484. And we see that 2484, if you divide that by the gross monthly income, we get 24.625, which is within the criteria. It's below 28. We want the criteria to be less than 28. And pity divided by gross monthly income is qualifying. Now, what I did in the three numerical columns on the left, I presented pity adjusted for their long-term debt, which is defined by greater than 10 months. Now, in the first numerical column, I have the credit cards of which they are paying $300 per month, car loan of $750 a month, and they have 3 years left, 36 months left on the car loan. So that is a long-term debt. And they also have an installment loan with the credit union for $250, which has a balance of $3,000 remaining, and they're willing to pay, they've indicated that they want to pay that off. That's the first long-term debt that they're looking to eliminate in order to get into the house, and they're going to pay off the installment loan with a credit union before closing on the house. They're going to put 20% down, which is $100,000, and the total closing cost is $7,000, and there's no PMI in this calculation. Now, when we look at, if we were to leave the three long-term debt items, credit cards, car, and the installment loan with the credit union, the pity plus the debt is $37.84. If we divide that by the gross monthly income, that gives us a ratio of 37.5, which is above our preferred mark. So that's not qualifying. However, they will have cash reserves. That's $100,000 down, $7,000. They have a savings of $110, which leaves $3,000. Okay. Now in the second numerical column, I eliminated, in this scenario, we have John and Martha paying off their installment loan with the credit union, which is a total of $3,000. That results in a pity plus the long-term debt of $35.34 and a ratio of 35, which is within the acceptable parameters of less than 36. The problem with this scenario is this leaves zero cash reserves. So they're paying $100,000 down payment. Closing is $7,000 plus $3,000 installment loan to the credit union. That leaves them zero cash reserves, which is not, of course, acceptable. Now, in the third scenario, we have John and Martha paying off the car auto loan as well as the installment loan with the credit union. The car auto loan has a remaining balance of $27,000. Now, if they're able to do this, they're able to bring their pity plus debt down to $27.84, and their ratio is 27.6, which is qualifying. However, they're in the negative here. They're minus $27,000 cash reserve. So they don't have enough cash to they don't actually have enough cash reserves to pay off the down payment, the closing cost, as well as enough debt to bring them within acceptable parameters. However, overall, there's a lot of good things going for John and Martha, both as borrowers and their collateral property. So based on this, what I did was, one simple thing that we can do is give them a 9% conventional loan. Of course, they would have to pay the PMI. So in this analysis, my recommended proposal, is that we give them a 9% conventional loan. They put 10% down. They take a loan of $450,000, which is a 9% conventional loan. They have to pay a PMI, and then we come out with a favorable situation where they're within the parameters with respect to the ratios of 28 and 36, and they have adequate cash reserves at the end of the transaction. So the private mortgage insurance PMI, I used 0.5%. I looked at several different sources, which I put in the reference at the end of this presentation. And home buyers with good FICO scores, which John and Martha have, will typically get 0.5% PMI. And that comes out to be $188 per month. Also, another adjustment to the PITI here is that with a 9% loan, the P&I, the principal and interest, go up an additional $246 per month. Here, the down payment is $50,000, 10%. Close is still $7,000. They're paying off the car, $27,000. The installment loan with the credit union of $3,000 getting paid off, and this is, if you look at the third column, and this is with the yellow and the green markers here, this their PITI in this scenario would be $29.18. They would only have their credit cards left $300 per month. Their car would be paid off. The installment loan with the credit union would be paid off, so they have 0 monthly payments here. The PITI plus debt is $32.18. If we divide that by the gross monthly income, that yields a ratio of 32, which is below the 36, the back-end ratio. And their cash reserves are $23,000 after they move into their home, they buy their home. So this is actually a reasonable scenario. So to summarize the key points of my presentation, my financial analysis is this. Under the category of collateral referring to the subject property, the main thing that we're using collateral is to secure the loan. And this house is in excellent condition. It's in a great location. I feel confident in saying that this property is going to be able to maintain its value. And in fact, it will likely go up in value. So as collateral, it is a secure value. It is secure collateral. Now looking at the capacity and credit, which looks at the character of John and Martha, I think that they'll be excellent borrowers. They're first-time home buyers. Their income is stable. They have 2 sources of income, so dual sources of income. They've been working at the same job for 4 more years. They've proven their ability to accumulate savings. Credit, they have excellent FICO scores. Now, on the negative side, they have a good amount of cash reserves, $110,000. That's a good amount of cash, which they've proven that they can accumulate. However, after they buy this home, they will have low cash reserves post-purchase. Now, their debt is manageable, but considering that they're buying a house, the ratios disqualify based on the debt, which therefore, as I presented in my analysis here, my recommendations are, instead of the original plan of an 80% conventional loan, my recommendations are that we look more closely into the conventional loan of 9%, which is a home loan of $450,000, a down payment of $50,000 with a PMI. So I believe that this is a reasonable loan that we can offer John and Martha. Other options is this, a piggyback loan, 80-10-10. That is another way that we can get John and Martha into this house with only 10% down. So their main issue is this: outside of buying, if they were not buying a home, they would have excellent cash reserves and their debt's manageable. However, considering that they're getting into a house using our strict criteria for a conventional loan, they're going to have low cash reserves at the end of the transaction, and the debt disqualifies them. So by giving them a 9% conventional loan or doing a piggyback loan, I mean, I'm thinking 10% down would result in good and manageable monthly payments, as well as adequate cash reserves once they've entered the home. Another thing to ask about is if they can get gifts from family. For example, their parents, if they contribute, they may help contribute to the down payment. And of course, I mean, we're talking about conventional loans in this analysis, but government loans are available to them, especially because they're first-time home buyers. So there's actually a lot of options for John and Martha, who are excellent candidates for future home buyers and good, responsible lenders, secured by an excellent property in good condition, in excellent condition, in a good location in San Diego. So my recommendation is that we do business with John and Martha. With respect to references, I list my references here as well as my contact number at the bottom. My main two references were California Real Estate Finance and California Real Estate Practice, and the additional numbers that I drew from the PMI numbers are also listed on the references. My name is Richard Kim, and my cell phone number and my direct line and my email are all here, so I welcome conversation about John and Martha and their getting them into their home. So, thank you for your time.